Gold's been making a lot of noise recently, and some analysts think the volume could get much louder. Before we begin, remember to like this video and subscribe for more economic updates. Gold's impressive resilience over the last 2 years, in the face of the fastest rate tightening cycle in 50 years, is well documented. Over the last couple of weeks, that resilience has developed into something stronger. Since the end of February, gold has climbed 6% to well above $2,100 per ounce. There are those who would like to write off gold's uptick as temporary, saying it's in reaction to possible rate cuts. But a growing number of analysts are saying the reasons are much wider and deeper, and that the upswing is a sign of a genuine bull run for the yellow metal. In a report published several days ago, Bloomberg analyst Marcus Ashworth declared that gold's record-setting pace is exuberantly rational. Ashworth makes it clear that the underlying reasons for gold's upswing are so strong that the recent dramatic rise is sustainable. Many of those reasons appear to be rooted in gold's long-standing reputation as a store of value. By now, a number of people may be familiar with the record levels of gold buying demonstrated by central banks over the last 2 years. The demand for gold has spread to individuals and institutions worldwide, which means the demand is much wider than just central banks. For example, Bloomberg's Marcus Ashworth cited data from the Swiss Federal Customs Administration that says physical exports of gold to China nearly tripled in January. In the assessment of Ashworth, that points to Chinese individuals looking for a haven in the most ancient form of financial security, following a rocky period for the country's real estate and equity markets. Ashworth confirms what we recently mentioned in an economic update, that institutional investors have increased their gold buying. He cites data from global multinational bank Societe Generale that says a record $11.3 billion of institutional dollars flowed into gold in February. Along the same lines, Ashworth points out that over the past 2 weeks, commodity exchange gold futures have seen the biggest jump in net new long positions in 5 years. Going forward, this analyst sees no shortage of gold drivers, which makes sense. With all the global uncertainty, the goal of many is to create stability, and gold is perceived as a store of value. Among them is America's ongoing fiscal uncertainty, about which Ashworth speculates. The accompanying increase in debt issuance will be relentless, adding to the bull case for enthusiasts of the precious metal. Does he see anything else adding to gold's momentum going forward? Escalating geopolitical tensions, the prospect of troubled elections in several countries, and an increasingly favorable economic backdrop for gold should pave the way for fresh highs. Ashworth doesn't project exactly how high those fresh highs might reach, but Natasha Kaneva does. She's J.P. Morgan's global head of commodities research. A handful of days ago, she revealed that gold is Morgan's #1 pick in commodities markets, adding, "We believe that $2,500 an ounce is a possibility. We don't know how high gold will soar in 2024. We do know that there are substantial reasons why gold should continue to grow. After all, do you think the world is more stable?" Until next time.